Hello and welcome. Today, we're going to unpack the really intricate set of rules that control banking in Uganda. It's a whole system designed to keep your money safe, make sure the economy is stable, and, well, manage the flow of cash itself. So let's jump right in.
So, have you ever wondered what it actually takes to start a bank in Uganda? I mean, it's not as simple as getting a big building with a vault. You have to navigate this incredibly complex legal maze, meet some seriously high standards, and earn the trust of both the public and a very, very powerful regulator. Let's find out how it's done.
All right, here's our game plan for this explainer. We're going to start with the main rule book, the fundamentals. Then, we'll look at all the different players on the field. After that, we'll walk you through exactly how you get a license, meet the official referee, and finally, see how this whole system is changing as we speak.
First up, we've got the absolute foundation of banking in the country, the Financial Institutions Act, or what everyone just calls the FIA. Honestly, think of this as the Constitution for banks. If you want to be in this business, every single move you make is guided by what's written in this document.
Now, the official definition of financial institution business is really revealing. It's way, way broader than just taking in deposits and handing out loans. We're talking foreign exchange, credit cards, money transfers, even things like investment advice. The law casts this super wide net to make sure that anyone handling the public's money is playing by the same strict rules.
And here's a perfect example of why that exact definition is so critical. In the huge Ham Enterprises case, the Supreme Court focused right in on the specific wording. See, a key change in 2016 said that lending had to involve money held on deposit. And because the foreign bank, DTB Kenya, wasn't technically holding deposits inside Uganda, the court said, nope, you're not conducting financial institution business here. That one ruling sent shockwaves through the system and really clarified the rules for foreign lenders.
Okay, so building on that, you need to understand that not all financial players are treated the same. The whole system is actually organized into different tiers. Each tier has its own rulebook and its own list of what it's allowed to do. It's basically a way of matching the level of regulation to the amount of risk involved.
So under the main act, you have these very distinct types of licenses. You've got your commercial banks. Those are the ones we all know and use for our daily deposits and loans. But then you have all these specialized players. Merchant banks, for example, they cater to big companies. Mortgage banks, as you can guess, focus only on property. And now you have Islamic banks, which operate completely under the principles of Sharia law. Each one has its own lane, its own specific job.
Now, the big takeaway here is the difference between, let's call it, the big leagues and the local leagues. Tier 1 institutions, like those commercial banks we just talked about, are under the direct and very strict watch of the Bank of Uganda. But the smaller guys, like your local money lenders, they fall under a totally different regulator, the Uganda Microfinance Regulatory Authority, or UMRA. And for them, the rules and the barriers to get in are completely different.
All right, now for the main event. How do you actually get through the gateway? How does a company get the legal green light to call itself a bank? Let me tell you, this isn't just a simple registration. It's an incredibly tough vetting process, and it's designed to weed out anyone who isn't absolutely ready for the responsibility.
The very first hurdle is massive. Thanks to a big update in 2022, you now need 120 billion Ugandan shillings in cash just sitting there as paid-up capital. That's over 30 million US dollars. This huge increase was done on purpose to make the whole banking system stronger, to make sure banks can handle major shocks, and to better protect our money. It's not a fee, it's a giant financial firewall right from day one. The process itself is just meticulous. You submit your application, but that's barely scratching the surface. You have to hand over detailed 3-year business plans, you have to reveal your entire capital and ownership structure, and every single director and major shareholder has to provide a personal declaration. Then, the Bank of Uganda takes up to 6 months to go through every single detail with a fine-tooth comb before they'll even think about giving you a yes or a no.
And maybe the most important part of that whole process is this: the fit and proper test. It sounds a bit old-fashioned, but the regulator is basically asking, are the people behind this bank honest? Are they competent? Do they have good judgment? Really, it all boils down to one question. Are these the kind of people you would trust with your life savings? If the answer is no, that application is dead in the water. Which brings us to the ultimate watchdog of this entire system, because getting a license is really just the beginning of a lifelong relationship with the Bank of Uganda. It acts as the supervisor, the regulator, and the disciplinarian for the entire sector. And its authority is absolute. I'm not kidding. This power doesn't just come from the Financial Institutions Act. It's actually written into the Constitution of Uganda. The BOU is legally empowered to be the one and only entity that oversees the financial sector to make sure it's stable and sound.
I mean, just look at the range of powers here. The BOU can do everything from routine inspections to issuing brand new rules. But if a bank starts to get into trouble, it can step in with corrective actions. And in really serious cases, it has the power to take over the management completely, put the bank into receivership, or even liquidate it, shut it down, to protect depositors' money. These are not small things. These are financial life or death powers.
So we've seen the rules, we've met the players, and we know the referee. But here's the thing. This system isn't static. It's not frozen in time. The whole regulatory landscape is constantly changing to keep up with new realities.
This timeline gives us a great snapshot of that evolution. You had the original act back in 2004. Then came those crucial updates in 2016. Then that massive jump in capital requirements in 2022. And just last year, in 2023, another really important change was made to open the door for a whole new type of bank.
This 2023 amendment, it's a really big deal. Before this, any Islamic banking product had to be approved by a Central Sharia Advisory Council, which created a huge bottleneck. By getting rid of that requirement, the law has made the process so much smoother, making it way easier and faster for licensed banks to offer these kinds of products. In fact, the very first Islamic banking license was handed out shortly after this change.
And behind all these big laws, you've got these crucial safety nets working in the background. First, there's a deposit protection fund that ensures every single customer up to 10 million shillings. Second, banks are forced to hold extra capital, a buffer for a rainy day. And to fight crime, any cash transaction over 20 million shillings gets automatically reported. These are the practical, day-to-day rules that keep the system safe for all of us.
So that brings us to our final thought. The laws we've been talking about were really built for a world of brick-and-mortar banks. But today, finance is moving at the speed of light. You've got fintech startups and mobile money completely changing the game. So the huge question for the future is this. Can a rulebook this detailed, this deliberate, actually adapt fast enough to regulate a new world of finance that literally lives in our phones?